37% in a single day, with no news, no announcement, nothing. That is not a normal market move. That is not a routine correction. That is an execution. Silver was trading at $121 on Friday morning. Within hours, it collapsed to $75. $46 erased in just 6 hours. Gold fell alongside it, dropping from $5,600 to $4,700. $900 gone. And here's the key point. No war broke out, no pandemic emerged, no major bank collapsed. There was nothing on the wires and nothing breaking across the news. Complete silence from every major outlet. Yet we just witnessed the largest single-day crash in precious metals in years, and nobody seems able to explain why it happened. But there is a reason, and once you see it, you'll understand why this keeps repeating itself. This same pattern played out in 1980. It happened again in 2011. And now, in 2026, it has happened for the third time. Same setup, same tool, same destruction. This is not a conspiracy theory. It is documented history. Welcome to the hidden economy. If you're new here, this channel breaks down what's really happening in markets while everyone else is distracted by headlines. Subscribe if you want analysis you won't hear anywhere else. And if you find value here, hit the like button so more people see this. Friday morning, January 30th. Last trading day of January. Last trading day of the week. Silver was sitting comfortably at $121. January had been the strongest month for silver in decades, up roughly 65% in just 30 days. Sentiment was euphoric. Analysts were calling for $200 silver, even $300. Social media was celebrating what many were calling the rally of a lifetime. Everyone believed they had bought the dip at exactly the right time. Everyone thought the move was unstoppable. Then 9:30 a.m. hit. New York opened. Within seconds, a tidal wave of sell orders slammed the market. This was not retail profit-taking. These were institutional-sized orders, massive blocks of silver dumped simultaneously. Millions of ounces hit the market at once, the kind of coordinated selling that does not happen by accident. Silver dropped from $120 to $115, then to $110, and then it broke below $100. That $100 level was psychological. It was supposed to be unbreakable. Analysts said it would hold. Support was assumed to be solid. It was obliterated in minutes. But the selling didn't stop there. 95, 90, 85, 80. Stop losses fired everywhere. Margin calls flooded trading accounts across the country. Traders were liquidated whether they wanted to sell or not. The system sold for them. By the close, silver sat at $75. Gold was at $4,700. 6 hours, 37%. Hundreds of billions in value wiped out. I watched it happen in real time. I watched fortunes vanish. I watched years of gains turn into dust in a matter of hours. And the question everyone asked that night was simple. What happened? What changed? The official answer was nothing. Just a correction, they said. Markets got ahead of themselves. A healthy pullback. That was the cover story. Here is what actually happened. Look at the 60 days leading up to Friday. Watch the dates carefully. On December 12th, silver was surging and making headlines. That same week, the CME Group, the exchange that controls silver futures, quietly raised margin requirements by 10%. It barely made the news. Silver kept climbing. On December 29th, with the rally still accelerating, the CME raised margins again, this time aggressively. A 25% increase overnight with no warning. Less than 24 hours later, on December 30th, they raised margins again. 2 hikes in 2 days. That almost never happens. Then, on January 28th, just 3 days before the crash, they did it again. This time, they changed the entire system, moving from fixed dollar margins to percentage-based margins. 9% became 11%. Riskier accounts jumped to 12.1%. 4 margin hikes in 6 weeks. An 80% total increase. Here's what that actually means. Margin is the cash required to hold a futures position. It's your collateral. When you trade silver futures, you don't pay the full price up front. You post a fraction of it. That's leverage. But when margin requirements are raised, every trader holding a position must post more cash immediately. Not next week. Not when it's convenient. Right now. If you can't deposit the extra money within hours, your position is liquidated. Sold automatically. No negotiation. No appeal. Imagine your landlord calling you and saying your rent just went up 80%, and you have until tonight to pay, or you're evicted. That is essentially the call that went out to every leveraged silver trader at the same time. Most people don't have that kind of cash sitting idle. They couldn't pay, so they were liquidated, forced to sell whether they wanted to or not. When thousands of leveraged traders are forced to sell simultaneously, the price doesn't drift lower. It collapses. That's how you get a 37% crash in a single day. This was not the market finding fair value. It wasn't a natural bubble popping. It wasn't profit-taking. This was the CME pulling a trigger. And here's the part that should disturb you. They've done this before. In 1980, silver ran from $6 to $50, an 800% gain in months. Regular people were making fortunes. The system was under pressure. The response? The CME introduced Silver Rule 7, effectively banning leveraged buying overnight. If you wanted silver, you had to pay 100% cash. No margin allowed. That same month, the Federal Reserve raised interest rates from 11% to 20% in one move. Silver collapsed from $50 to $10, an 80% wipeout. In 2011, silver ran from $8 to $50, a 600% gain. Retail traders piled in. Banks with massive short positions were getting crushed. The response? The CME raised margins 5 times in 9 days, 5 hikes in 9 days, an 84% increase. Silver collapsed from $50 to $26, losing half its value in weeks. It took 13 years to recover. Now here we are in 2026. Silver ran from $26 to $121, a 450% gain, the largest rally in modern history. The response was identical. 4 margin hikes in 6 weeks. The result? A 37% crash in 1 day. 3 times in 50 years. Same setup, same tool, same outcome. Every time silver threatens to break out, every time regular people begin accumulating real wealth in precious metals, every time gold and silver start exposing the weakness of the paper system, the same playbook is executed. This is not coincidence. It's not risk management. It's a pattern. So why does silver matter this much? The answer has little to do with silver itself. It has everything to do with what it represents. This is about the dollar. The United States holds one unmatched advantage: the world reserve currency. Every country needs dollars to buy oil, trade globally, and hold reserves. That's why America can print trillions, run massive deficits, and survive. But that system is changing. Fast. Central banks bought roughly 800 tons of gold last year. Not dollars, not treasuries, physical gold. In January alone, they sold $48 billion in U.S. treasuries. The dollar's share of global reserves has fallen to 58%, the lowest level since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Central banks trust metal more than America's promise to pay. Leading this shift are the BRICS nations: China, Russia, India, Brazil, South Africa. They're building payment systems that bypass the dollar and settling trade in their own currencies. Now look at China specifically. China controls 60 to 70% of global silver refining. Not mining, refining. Without Chinese refineries, the global silver supply chain breaks. They also control 90% of rare earth processing, 98% of gallium refining, 80% of cobalt processing, and 60% of lithium refining. Modern technology and military systems run through Chinese processing facilities. On January 1st, China classified silver as a strategic national security resource and imposed export controls. 2 superpowers, 2 visions. China wants a world where physical resources hold power. America needs metals to stay cheap and gold to stay quiet. If silver hits $500, what does that say about the dollar? If gold hits $10,000, what message does that send? So silver gets crushed. Margin hikes, forced liquidations, price destruction. Meanwhile, China buys the physical metal. This isn't market management. It's financial warfare. Look at the dollar. It fell from 110 to 95.55, a 4-year low. As the dollar bottomed and reversed, metals crashed. Margin hikes created forced selling. The dollar rebound provided the excuse. Now look at the physical market. Even at $121, mints were struggling. The Perth Mint suspended wholesale orders. The U.S. Mint halted Silver Eagle sales. Dealers defaulted. Now spot is $75. Try buying physical silver. Check premiums. Check availability. Paper says $75. Physical says something else. Paper silver can be created and destroyed instantly. Physical silver cannot. Two markets, two prices, two realities. While the West panic sold paper, Shanghai vaults drained 27 tons of silver in a single day. Physical metal moved east. The fundamentals never changed. 5 consecutive years of supply deficits. Over 800 million ounces gone. Industrial demand accelerating. Supply constrained. Paper prices can be manipulated. Physical reality cannot. They suppressed silver before. It recovered. They can do it again, but not forever. I don't know if $75 is the bottom. It could go lower. It could rebound sharply. Nobody knows. But if silver doesn't matter, why crush it 3 times in 50 years? Why run the same playbook? Friday wasn't just a crash. It was a message. And it was confirmation. Silver still matters. That may be the most bullish signal of all. This is the hidden economy.